Hello, welcome back. Here is Ali Talabi, and this is the wrap-up session for Module 10. So in this module, we'll talk about the cost of capital. So let's first review some major notes and hints for this module. So we talk about the weighted average cost of capital. So most of times when you're referring to WACC, we are talking about the firm level cost of capital. However, you can also apply the WACC for projects, which is for a specific company. However, sometimes you might end up adjusting the WACC for the specific project because sometimes the companies are taking projects which they have lower or higher risk. In this case, based on the risk, you have to adjust the cost of capital. So if you know, for example, which department is taking that project, or if you know similar projects within that firm, you might use the similar cost of capital for those projects. So it doesn't mean that always you have to use the firm's cost of capital. You have to be careful. In these cases, when it comes to project, it's more relevant to consider the cost of capital for that specific project. So we talk about the capital structure, and we mentioned the capital structure is very critical in the cost of capital because the combination of debt and equity impact on the cost of capital. Specifically, we learned that when you are using the debt, you can save some money because actually it reduces the tax amount you are paying. So changing the capital structure, changing the combination of debt and equity will impact on the cost of capital. So you have to be careful with that. So it will change the expected return by investors. It will change the beta, which we talk about that, and I will mention about the beta in module 13 as well. So in results, the cost of capital will be a different number. So when we are talking about the value of the firm, one of the application of the weighted average cost of capital is to find the value of the firm. So we can use the free cash flow, we can use the WACC or weighted average cost of capital to find the value of the firm. So how we do that? If you just simply divide the free cash flow 1 year from now, or FCF1, WACC minus G, G is the free cash flow growth rate, you can find the value of the firm. We talk about the market value versus the book value when it comes to cost of capital. It's much more preferred to use the market value instead of the book value for the weights when it comes to cost of capital. And again and again and again, just make sure you're applying the tax portion or the tax saving portion to the cost of debt. You shouldn't apply the tax to the cost of equity, because again, interest is the acceptable expense when it comes to the tax payment. So we didn't talk that much about the return earnings. Some companies, they use the return earnings to invest in the project. Remember, the return earnings are not free. So usually their cost is very similar to the cost of equity, but there is one major difference. And what is the major difference? It's a flotation cost. If companies, they issue shares, they sell additional shares, there will be some costs associated with the selling the shares. For example, they need to pay to some advisors, consulting firms, they need to go with some legal procedure, and all those are kind of costly. So those costs are called flotation costs, which usually express in terms of the percentage of the financing. So maybe 5%, 6% of the total financing from equity should be allocated to flotation costs. So just 94, 95% is left for the company. However, if the companies are using return earnings, there is no flotation cost. In other words, the cost of equity using the return earnings, it's a little bit cheaper than the cost of equity which comes from selling additional shares. So in this regard, you can say the cost of issuing new shares, that's the most expensive one, followed by the cost of equity using the return earnings, and the last one is the cost of debt. Why the cost of debt is the cheapest one? The major reason is the tax saving. So we should go with the after tax, as we argued before. So this is the major notes. Let's quickly look at the question. Let's go with the first question, see what we have here. So first question, which of the following events would increase the cost of capital? a reduction in the proportion of equity in the firm. So we learned that when the equity is going down, it means you are financing more from debt. Now, if we assume the cost of debt itself is fixed, so it's not changing. So for example, if you need $500,000 or $1 million, still you can get the same rate or the same interest rate, but you can save higher taxes actually in a higher debt. It means your after-tax cost of debt will be lower in this case. So when you are reducing the proportion of equity, it means you increase the proportion of debt, which means you can save more, which means your total cost of capital will be lower. So you're right. So A is not the answer because we are looking for the increase in the cost of capital. B, a reduction in the growth rate of the dividend. So we learned that one way to calculate the cost of equity is using the DDM or dividend discount model, which was based on the dividend yield and the dividend growth rate. So in this case, it's saying reduction in the growth rate, which means G is going down, which means the cost of equity will go down. However, we are looking for the increase in the cost of equity or the increase in the cost of capital. So the answer shouldn't be B. C is saying an increase in the market return. So we also learned we can calculate the cost of equity by using CAPM, which was the risk-free rate plus the market return minus the risk-free rate times beta. We also call this market risk premium. So when the market return is going up, the cost of equity should go up, which means the cost of equity will go up, which means the cost of capital will go up. So the answer should be C. But why not E or D? So let's look at D. A reduction in the beta of the stock. So if the beta is going down, you can see from the CAPM that the cost of equity also is going down. So D shouldn't be the answer. E, an increase in the tax rate. So we learned that as the tax rate is going up, it means you can save more. It means your after-tax cost of debt will be lower in this case, which means your cost of capital will go down. So E also reduces the cost of capital. So the only correct answer in this case should be C. Now let's look at the second question. A company has a beta of 1.2, the risk-free rate of 5%, and the expected market risk premium of 10%. We're looking for the required 10 on this stock. So we can use the CAPM formula as you see to find the answer. Here you have to be careful. Why? Because the market risk premium is given, not the market return. What's the difference? That's a market return, and market return minus the risk rate, that's a market risk premium. So since the market premium is given, I can say the whole thing RM minus RF is 10%. Now I can plug the numbers and I can find the cost of equity. The cost of the risk-free rate here in this case is 5%. The beta also is 1.2. So let's find the cost of equity. So 1.2 times 10%, 12%. So the whole thing here is 12%. And the risk-free rate is 5%. So 5% plus 12%, it should be 17%. So the cost of equity in this case should be 17%. So the answer should be A. Again, the only tricky point here is to distinguish between the market return and the market risk premium, which is the difference between the market return and the risk-free rate. Now let's look at the third question. So this question is regarding the bond. So we learned how to find the value of the bond, and I mentioned the most relevant cost of debt when it comes to bond is the YTM, so yield to maturity. Now, to find the yield to maturity, I need to use my financial calculator, and I'm referring to the third line of my financial calculator. So let's see what we have here and how we can find the YTM. So what is your N here? You have 5 years to maturity, so your N is 5. Your I here in this case is the number we are looking for, which is your YTM. The present value is $920. Be careful, because in your calculator you should to enter the negative number. That's the amount you are paying for the bonds. The payment is based on the coupon rate. Here is saying the coupon rate is 10%. So 10% of $1,000, which is the face value, should be $100, and the face value is $1,000. So let's calculate the YTM. 5N 920 PV, PMT 100, and 1000 is FV. When you calculate your I, it gives you 12.23%. As you see, 12.23%. So 12.23% almost. But remember, the question is asking for the after-tax cost of debt. So you have to multiply the number you calculated by 1 minus tax rate, which is 35%. So in other words, I'm multiplying the rate I calculated by 0.65%. So the number I'm getting here is 7.95%. So your after-tax cost of debt should be 7.95%. So the correct answer should be D. Now let's look at the last question. Secure Yourself is specialized in home security cameras and has a WACC of 13%. The company is considering manufacturing security cameras for cars. Secure Ourselves specializes in security cameras for cars and has a WACC of 11%. What discount rate should Secure Yourself use to evaluate this investment? I talk about the WACC, what is the appropriate cost of capital. When you are investing in a project, you should consider the risk of that project. So the most relevant will be the equivalent type of cost of capital, which you can find in comparable companies or comparable departments. So in this case, remember the 11% is actually more relevant because you are talking about that investment, you're talking about that business instead of 13%. You shouldn't use the average rate, you shouldn't use the firm cost of capital, just go with the risk adjusted cost of capital, which in this case should be 11%. So B should be the correct answer. That's it for today. Thank you very much. Here is Ali Talabi, and take care. Have a wonderful day. Talk to you soon. Bye.